What if everything you believed about the silver market just broke? What if the price action you're watching is no longer the story? Because what happened in Shanghai this weekend wasn't volatility, it was a loss of control. This was not a routine move. This was not a technical adjustment. This was an emergency response from an exchange that saw something spiraling faster than its models could handle. Here's the part nobody realized. While most investors were focused on silver printing new highs, while charts flashed momentum signals and social media debated targets, Shanghai Futures Exchange quietly slammed the emergency brake. They hiked margin requirements to levels rarely seen in modern commodity markets. They did it over a weekend, and they did it without warning. That combination matters. Let me show you. Exchanges do not change rules after markets close unless they are afraid of what happens when markets open. They don't act on emotion. They act on risk exposure. And right now, Shanghai is exposed. You were told silver is just rallying. You were told this is another speculative surge. You were told prices will cool like they always do. That story doesn't survive this move because margin hikes are not about price. They're about counterparty risk. In futures markets, margin is not a down payment. It's a survival buffer. When an exchange raises margins aggressively, it's admitting one thing. They are no longer confident that participants can meet obligations if prices keep moving. Think about that for a moment. Normal commodity margins sit comfortably in the single digits. 10% is already defensive, 16% signals concern, 17% signals panic. Shanghai was already at elevated levels before this hike. They looked at the market and decided that still wasn't enough. That tells you everything. This was not planned months in advance. This was not discussed publicly. This was a reaction. And reactions reveal stress. Here's where the structure matters. There are two silver markets in the world, even though most people only watch one. New York is the paper market. It's leveraged. It's cash settled. It's built for speculation. Shanghai is different. Shanghai is the physical market. It is where manufacturers hedge real demand. It is where factories secure metal they actually need to keep production lines running. Paper traders can exit positions. Factories can't exit reality. That distinction is why Shanghai matters more than any price print on a screen. China is not a marginal silver buyer. It is the single largest industrial consumer on the planet. Solar panels, electric vehicles, electronics, grid infrastructure, all of it runs through silver. And in most of these applications, there is no substitute that works at scale. Silver isn't used because it's fashionable. It's used because physics demands it. Highest conductivity, lowest resistance, reliable under heat and stress. This already happened before. Whenever a material shifts from tradable to essential, markets behave differently, prices stop clearing smoothly, control becomes the priority. That's what you're watching now. Shanghai didn't hike margins because traders were excited. They did it because delivery pressure was building, requests for physical metal were stacking up, paper supply wasn't matching physical demand, and the exchange realized it was sitting between two sides that no longer balanced. This is the breaking point. When paper markets can no longer absorb physical reality, exchanges intervene, not to protect investors, to protect themselves. Here's the doom mechanism. Raising margins forces leveraged traders to liquidate. Liquidation creates paper selling. Paper selling pushes prices down. That's the theory. But theory only works if demand is optional. Industrial demand is not optional. A solar manufacturer does not stop production because margins went up. An EV factory does not delay output because futures traders are uncomfortable. They buy the metal, and every time paper prices are smashed artificially, physical buyers step in faster. This is where control attempts backfire. You can suppress price temporarily. You cannot suppress necessity. That's why this move is so important. Shanghai just told you, without saying it directly, that the physical silver market is overheating beyond what paper mechanisms can manage. They didn't signal strength. They signaled fear. This is not the end of the move. This is the beginning of the fracture. Because once exchanges start intervening this aggressively, they reveal that price discovery is no longer functioning normally. And when price discovery breaks, repricing doesn't happen smoothly. It happens violently. You are not watching a rally. You are watching a system being forced to choose between paper promises and physical delivery. Shanghai chose control. History shows what comes next. And it never ends quietly. To understand why Shanghai's move matters, you have to forget price for a moment, forget charts, forget targets. What matters now is structure. Here's the part nobody realized. Paper markets only work when physical demand is flexible, when users can wait, when delivery is optional. Silver is no longer in that category. Shanghai Futures Exchange is not designed for speculation dominance the way New York is. It exists to service industrial demand. Factories hedge there because they intend to take metal, not roll contracts forever. That is why Shanghai panics first. Think about that for a moment. When an exchange closest to physical delivery loses control, The problem is not leverage, it's availability. This already happened before. In past commodity crises, the first warning was never a price spike. It was rule changes, higher margins, delivery restrictions, position limits. Those are not confidence signals, they are containment tools. Shanghai's margin hike was not meant to stop silver from rising. It was meant to stop traders from demanding metal faster than warehouses could supply it. That distinction is critical. In the paper market, selling pressure relieves stress. In the physical market, selling pressure does nothing if buyers need delivery. And right now, buyers need delivery. China's industrial demand for silver is not theoretical, it is contractual. Solar deployment alone is consuming hundreds of millions of ounces annually. Electric vehicle production continues to scale. Electronics manufacturing has no viable substitute. Silver sits inside all of it, not as decoration, as infrastructure. This is the mathematical trap. Global silver mine supply has been flat for years. Recycling cannot scale fast enough. New mines take a decade to bring online, assuming permits are even granted. Demand, meanwhile, is accelerating now. That creates a condition where paper suppression no longer clears the market. And that's exactly what Shanghai is signaling. Here's how the mechanism breaks. When margins rise, leveraged traders are forced out. They sell contracts. Prices dip. But the moment prices dip, physical buyers step in. Factories see discounted metal and lock in supply. Procurement teams accelerate purchases. Inventory disappears. So the paper market sells, but the physical market tightens. That divergence widens. This is the paper versus physical split analysts have warned about for years. As long as paper markets dominated price discovery, physical shortages could be hidden. Once physical buyers assert themselves, paper loses control. That is the breaking point you're approaching. Shanghai understands this. That's why their move feels desperate. They are not fighting speculators. They are fighting inevitability. Because no margin hike creates silver bars. No rule change increases conductivity supply. No exchange policy changes physics. Think about that for a moment. You can slow trading. You can scare leverage. You can even crash price temporarily. But you cannot stop factories from needing metal. This is why margin hikes fail late in cycles. They don't solve shortages. They expose them. Every emergency intervention tells the same story. We are running out of options. This already happened before. In oil markets, in grain markets, in base metals, the pattern is always the same. First, prices surge. Then authorities intervene. Then physical demand ignores them. Then control breaks. Shanghai is at step 2, which means step 3 is already underway. The most dangerous assumption right now is believing this is just volatility. It's not. Volatility implies balance. This implies stress. The exchange is trying to force paper liquidation faster than physical demand can absorb metal. That only works until someone stands for delivery. And once that happens at scale, the entire structure changes. Because futures markets are not built to deliver everything they promise, they are built on the assumption that most participants will settle in cash. If that assumption fails, the system fails. That's the real fear behind Shanghai's move, not price, delivery. Once enough participants demand physical metal, exchanges face an impossible choice. Change the rules or expose the shortage. Margin hikes are the first line of defense. They rarely work for long because they don't change reality. They just delay recognition. This is where the silver market shifts from trade to event. Paper can lie. Warehouses can't. Shanghai just told you which one is winning. And when physical reality wins, the repricing is never polite. It doesn't ask permission, it forces it. Every market reaches a moment where control stops working. Not because authorities give up, but because math takes over. This is that moment for silver. Here's the part nobody realized. Shanghai's margin hike was not the solution. It was the admission. When exchanges intervene this aggressively, they are no longer managing volatility, they are rationing time. Think about that for a moment. Margins don't fix shortages. They don't create supply. They only change who can stay in the market long enough to demand delivery. That's the real objective. This already happened before. In past commodity crises, exchanges always try the same sequence. First, raise margins, then limit positions, then slow delivery. Each step buys time. None of them restore balance. Silver is now moving through that sequence. Here's the hidden mechanism. Futures markets are built on leverage and rollover. Most contracts are never meant to be delivered. They exist to hedge price, not to move metal. That system only works as long as physical buyers behave like financial participants. But industrial buyers don't. Factories don't care about futures curves. They care about inventory. When price spikes, they don't exit. They accelerate. When exchanges try to smash price with paper selling, factories see opportunity. They lock supply. They drain warehouses. This is the inversion point. Paper selling is supposed to relieve pressure. Instead, it intensifies it. S dynamic better than anyone. They see delivery requests, they see warehouse flows, they see how much metal is actually available, and they see the gap. This is why their intervention came suddenly, why it came on a weekend, why it came without consultation. This was not policy. This was containment. Here's where the math becomes unavoidable. Global silver supply is structurally constrained. Mine output is flat. Recycling is slow. Demand is accelerating now. That combination guarantees one outcome. Shortages don't resolve gradually. They snap. And when they snap, prices don't move in increments. They gap. This already happened before. In other metals, in energy markets, in food markets. The pattern never changes. Authorities intervene. Markets ignore them. Reality asserts itself. Silver is following that script. Now, look at behavior. When margins rise, leveraged speculators exit. That creates temporary calm. But physical buyers do not exit. They step in. And once physical buyers dominate price discovery, futures markets lose relevance. That's the existential threat exchanges face, because exchanges are built to intermediate paper risk, not physical scarcity. When scarcity dominates, the rules stop working. This is the real breaking point. Not price highs, not volatility, delivery stress. That's why Shanghai's move matters more than any chart. It tells you that the exchange is worried about what happens if too many participants demand metal at the same time. And that worry is justified, because there isn't enough silver to satisfy all paper claims. Think about that for a moment. Futures markets promise more metal than exists. That's normal. It only becomes dangerous when people stop rolling contracts and start asking for bars. That shift is happening now, not because of speculation, because of necessity. Solar factories don't pause, EV lines don't slow, electronics don't wait. They pull metal forward. This is the doom mechanism. The more authorities intervene, the more physical buyers front-run supply. The more they front-run, the tighter inventories become. The tighter inventories become, the more fragile the system gets. It feeds on itself. This is why late-cycle control always fails. It's fighting behavior that cannot be regulated away. Shanghai knows this. That's why the move felt panicked. They are not trying to stop silver from rising. They are trying to slow the rate at which reality reveals itself. Because once delivery failures appear openly, the game changes, confidence evaporates, paper premiums detach, physical prices diverge. At that point, the market no longer functions as one market. It fractures. This is where silver is heading, not toward a smooth bull market, toward a structural repricing event, one driven by scarcity, not sentiment. You are not watching speculation. You are watching the limits of control. And history is clear on what happens next. When control fails, repricing doesn't wait for consensus. It happens whether participants are ready or not. Shanghai just told you they are not ready. That's the signal. And it's louder than any price spike. Every manipulated market eventually reaches the same moment. Not when prices spike, but when control stops working. This is that moment for silver. Here's the part nobody wants to admit. If Shanghai's margin hike worked, this story would already be over. Prices would cool, volatility would fade. But that isn't what's happening, because control only works when demand is optional. Silver demand is not. This already happened before. In every commodity crisis that mattered, authorities tried the same playbook. Raise margins, limit leverage, slow trading. And in every case, it failed once physical necessity overwhelmed paper discipline. Oil in the 1970s, natural gas in Europe, food commodities during shortages. The pattern never changes. Paper tools cannot override physical need. Think about that for a moment. A futures exchange can raise margins overnight. It can force speculators out. It can even crash the paper price. But it cannot tell a factory to stop producing. It cannot tell a government to pause energy deployment. It cannot tell an industrial buyer to wait. This is where the system breaks. Shanghai's panic move tells you something critical. They are no longer confident that paper mechanisms can control physical flows. That's why this matters globally. Shanghai is not a fringe exchange. It sits at the center of industrial silver demand. When Shanghai loses control, the entire supply chain feels it. This is the hidden agenda behind the intervention. The goal is not price stability, it's time. Time to source metal, time to negotiate contracts, time to avoid visible delivery failures. But time is the one thing scarcity does not give. As physical buyers accelerate purchases, inventories thin. As inventories thin, delivery risk rises. As delivery risk rises, confidence collapses. This is the countdown phase. The next step is predictable. Physical premiums continue to separate from paper prices. Delivery timelines extend. Exchanges introduce more temporary rules. Each move framed as risk management, each move revealing less control. This already happened before. In every market where paper promised more than reality could deliver, the end came the same way. Not with an announcement, with a divergence. Paper prices saying one thing, physical prices saying another. Once that split becomes visible, trust never fully returns. That's the real danger. Because futures markets depend on trust. Trust that delivery is possible. Trust that settlement reflects reality. When that trust cracks, participants change behavior permanently. They stop rolling contracts. They demand metal. They bypass exchanges. And once that behavior spreads, the market does not go back to normal. This is the irreversible phase. Shanghai is trying to stop that behavior from becoming contagious. That's why the move felt desperate, because they know what comes next if it fails. You're already seeing early signs: rising physical premiums, longer lead times, reports of tightness at the wholesale level. Those are not bullish indicators, they are stress indicators. They tell you the system is being stretched beyond design limits. This is not about upside targets, it's not about price predictions, it's about structure. And structurally, the silver market is no longer balanced. Supply is flat, demand is accelerating, paper claims exceed physical availability. That equation only resolves one way, not gradually, not politely. Historically, this is the phase where authorities lose narrative control. They keep intervening, markets keep ignoring them, reality keeps asserting itself, until one day the interventions stop working altogether. That's the breaking point. And Shanghai's move tells you we are much closer to that point than most people realize. You were told this was just another rally. You were told volatility would settle. You were told exchanges had tools.